Hi guys! Around 7 months ago, I shared in this video how I was changing my investment strategy to a simpler one because I was just simply too busy. My portfolio's growth depend on my available time, and when I travel, I don't really have the mind space or the energy after work or even doing life. So this meant that if I continued to do active investing, I was either missing out on opportunities or even worse, not investing at all. So I decided to build a system that was easy and simple. I shared the rationale and logic behind it, and one of them was to do an automatic recurring investment into a globally diversified ETF, a set it and forget it approach that removes human error and emotions, one that could be built over a period of 20 years. That was my target, reducing any impact of short-term fluctuations and focus on long-term growth. By automating this, I found that I freed up around minimally 10 hours every week that I used to research on stocks or monitor my positions. Active investing was something that I could do if I wanted to. Even if I didn't do it, I would still have something to fall back on. And I used those 10 hours to more fruitful things like resting, planning my holidays guilt-free. So today's video is one of the highly requested videos, a 7-month update on how that investment has been doing. And I'm going to pull back the curtain to share with you how this hands-off strategy has performed. And I will also share the emotional roller coaster that I went through with my own portfolio and how one of the comments and a few conversations that I've had with friends led me to comparing a few other ETFs, and I ended up doing a slight tweak to my existing portfolio. So stay tuned for that. As I've shared my story before in this video, I was laid off at 31 years old, went on a 4-year sabbatical, starting from zero to rebuild my portfolio to a 6-digit portfolio. And the key reason was investing. And that is the reason why I 100% believe in investing, because inflation is real. Doing nothing with my money is still a decision. So personally, I do keep very little in my high yield savings account and I do not optimize them. I optimize my credit cards because it's fun to me. So historically, I have kept enough emergency fund and I have invested the rest. And that's how I really rebuilt my 6-digit portfolio in 3+ years. And I believe that anyone can start investing, because if you are really afraid to start investing, what I do is invest my bubble tea / junk food money. So the money that I would have wasted on things like bubble tea or junk food that does nothing for my body, then I thought, you know what, let's just use that money. All this money would have been lost spending on these things anyway. So that's the thought process that I have. This video is for edutainment purposes and I'm not encouraging you guys to buy whatever I'm buying. It's just that I'm sharing with you what I'm doing, and past performance is not indicative of future results. And as always, this is not financial advice. I am not your financial advisor, and I'm only sharing my journey, my learnings, and my thought process. Without further ado, let's go, and I'm going to show you guys my portfolio. So I started a recurring investment of $500 per month from 30th May 2025, and I did it on the IBKR platform, which is Interactive Brokers. Recently, I wanted to keep track of all my investments across different brokerages, so I started to use this platform called Potsado because I could import my data easily. Over the years, I have had a lot of investments and trades, and I didn't want to import them one by one. So when I pull up my Potsado, I can see my entire portfolio in one dashboard view after porting my portfolio from Moomoo, IBKR, Tiger, and Webull. And I also specifically wanted to see my time-weighted return, TWR, to see how my stock portfolio is doing against the S&P 500. Basically, it's how fund managers track their performance, because I want to see whether or not my own personal portfolio of other stocks have done well. So for 7 months, my system did its thing in terms of recurring investment. I didn't interfere even when I felt the itch. There were moments of doubt. Some months I look at my portfolio and I feel like it's moving so slowly as compared to my other stocks that have gone up like 20%, 30%. And other times it went down to -4% during the recent market correction. And my heart was like, I felt this slight pinch. But the best is to not look at it. If you've ever felt that way, you are not alone. I wanted to share this because the whole point of this system is to take out these emotional waves out of our investing. So how did it do? As of 27th of December 2025, this part of my portfolio, which is 6 transactions altogether, is up by 9.56% over 7 months with an unrealized gain of $369.05. Now, this is just a snapshot in time reflecting a specific market environment. It's not a sure win. 7 months is a blink of an eye for a 20-year strategy. What mattered more to me is that my system worked exactly as I intended. It invested when I was busy, when I was uninspired, when the market went down, and it did not need my constant attention. That's a clear win for me. So here's what really got me thinking. High yield savings account has its place and I 100% believe in it. But bank rates are going down, and no matter what, the cash that is in our banks are just going to have lesser and lesser interest. All the more it's really important for me to start making my money work harder for me. So if you have found this sharing of my investment journey helpful, can you do me a favor and hit the like and subscribe button, because it really helps me build better content. In exchange, I will give you a heart. At the same time, even though this system worked, I stopped buying in November. Let me explain more. You see, after my last video, there were a few comments in the YouTube that got me to really deep dive into other ETFs like VWRA and ACWD, and I researched quite a lot. Instead of a boring list of specs, I'm just going to share with you guys 2 questions that I was basically asking. What do I actually own in the index? Firstly, they are all Ireland domiciled UCITS ETFs, which is more tax efficient for a Singaporean investor like me. So instead of 30% of dividend withholding tax, I only pay 15%. The second one is that all are accumulating ETFs, which means that dividends are automatically reinvested. So VWRA and FWRA both track the FTSE All World Index. They provide functionally similar market exposure of developed and emerging markets with thousands of large and mid-cap companies globally, while ACWD tracks MSCI All Country World Index. It is also global, but it just uses a different index methodology, holding around 2,300 stocks. I did an evaluation and I realized that the difference is actually not a lot. Whether or not I switch from one to the other doesn't really make a huge difference, and I could stick with any one and I do really well anyway. The second one is, what is the ongoing friction, the cost? ETFs are already very low cost, so it's really one of the most preferred investment methods that I have personally. But there are 2 costs to consider. The first one is the ongoing fund cost. This is the total expense ratio, which is a small annual fee deducted from the fund itself. It's like a built-in maintenance fee to keep the fund going and to keep the lights on. For the 3 ETFs that I researched, VWRA, it has a total expense ratio of 0.19% per year, FWRA 0.15% per year, and ACWD 0.12% per year. And to my surprise, ACWD also started the earliest and has the longest history. Even though lower fees does not guarantee higher returns, but over time, lower total expense ratio can help us keep more money invested as long as the ETF continues to track its market reasonably well. That's why I don't just look at fees alone. I also monitor whether the ETF behaves the way that it's supposed to, like tracking differences, etc. The other cost that we pay is the trading cost, which is every single time that we buy or sell, we would need to pay a small fee. As compared to the past where we need to pay $25 to $40. Right now I just pay USD $1.70, which is really affordable and I have nothing to complain about. And that is more to do with platform, which I'll explain later. I also looked at liquidity, which is something that I hope I never have to think about, but I still checked it anyway because I want to avoid any obvious red flags. ACWD has about 9 billion worth of AUM, FWRA has about 2 billion, and VWRA has about 51 billion. So if you think about it, that was why I started with VWRA. Bigger or more established ETFs like VWRA with a bigger AUM tends to trade more smoothly with a tighter buy-sell price difference, which is also what you can see in the bid and ask spread that people usually talk about. So for someone investing regularly for the long term like me, this isn't a deal breaker, it's just something to keep in mind. After weighing the options, I decided to direct my new contributions to ACWD while keeping my existing VWRA holdings unchanged. because ACWD offers functionally similar index exposure as VWRA with the lowest stated expense ratio, which may reduce my long-term cost drag if tracking and implementation remains comparable. This is not a performance call or market timing, it's just a cost and process decision. You could say I'm just trying to optimize my portfolio, but I did not sell my VWRA because VWRA remains a solid globally diversified ETF. Selling it would just mean transaction costs, which I don't need right now, so I'm just choosing to keep it anyway. Instead, I'm just redirecting my new money to optimize my portfolio further. Think of it as switching from a more expensive brand of similar product to a cheaper one. But the more important thing that I did was to bump up my monthly investment from USD $500 to USD $2,000. This did two things for me. The first one is to reduce my trading cost. So here's the math. IBKR, under their tiered pricing, which I'm currently on, charges 0.05% with a minimum of USD $1.70 per trade when I buy or sell. Just as optimization, right? $3,400 of USD investment would be the optimal amount for me to maximize this $1.70. But I don't have so much cash on hand per month, so $2,000 is my comfortable amount. The more important thing that has been proven over and over again is that how much you invest often matters more than finding the perfect ETF to reduce the slight cost. As my income grows, the contribution size becomes a more powerful lever for wealth creation than shaving off a few basis points in fees. One of the questions that I've had is, why not FSM1? FSM1's ETF RSP, which is regular savings plan, is excellent for small monthly buys, especially because the buy fee is waived under their 0% processing fee promotion that's been going on since 2021. And you can start as little as $50. So this encourages you to start from very little money and is very helpful for those who are just starting out or fresh graduates, or even those who are doing part-time studies and part-time work. But when it comes to selling, FSM1's published fees for the London Stock Exchange trade, which is where ACWD is on, charges 0.15% of your sell trade with a minimum charge of $20, which means that smaller portfolios can feel the minimum charges more heavily upon selling. I don't think that there is a universally better platform, it's just what fits how you invest, and I personally like flexibility, therefore I've chosen IBKR for now. And also it allows me to, right now, example, switch ETFs without incurring huge costs. So if you are thinking of setting up IBKR, you can use the link below if you would like. But here's how I set up my pricing plan, because when you first sign up for IBKR, we will all be under fixed pricing. So the first one is I make sure that my setting is under tiered pricing. I go to the little man icon and click on settings. Under account configuration, click on IBKR pricing plan and choose tiered pricing as shown in the picture. Next, I set up recurring investments on IBKR. So I go to trade under recurring investments, create recurring investments, and I choose ACWD or whatever I would like to invest. Next, fill up the relevant amounts, determine the end date if any, click continue, check through and click save investment. And I will see my success page. 7 months in, here's what I truly believe in. Automation is so much better than willpower. This system executed flawlessly without my emotions getting in the way, and even though I don't get the lowest price, it did help me buy when the market went down. And on hindsight, it's always great. Number 2, boring is a feature. If I'm getting an adrenaline rush, I'm likely gambling. The third one is control the controllables. I cannot control the returns, but I can control my contribution amount, my cost, and my behavior to not do anything. So an update of what I intend to do with the money. My personal goal is that by 2026, I plan to buy a house and use this money as a down payment. So I'll keep you guys posted on how that journey unfolds. Some key takeaways that I've had from this journey of investing is that it's a continuous learning and refinement. I start small and I gain confidence, and I'm not afraid to make small adjustments along the way, and I hope that this will help you to do the same. Increasing my income and contribution is really the top priority, especially when I've gained a lot more confidence. If this has helped you, help me do 3 things. First, subscribe to my YouTube channel to follow along my journey. Number 2, comment and let me know what your strategy is or what your concerns are, because I would love to hear from you. And finally, number 3, join my Telegram channel if you're interested to get alerted with special sign-up deals of travel insurance, credit cards, or bank accounts. Thanks for watching, and I'll see you in the next video.